multifamily maturities weaken while office improves. They're reporting that loan payoffs for apartment borrowers went down even as office payouts improved slightly. We've covered the wall of multifamily loan maturities on the Gray Report. We even discussed when we covered it, like, it's not going to be, things aren't going to be like burning down. There's not going to be huge, there's not going to be huge levels of crisis, but there will be maybe gradual, pockets of opportunity and distress caused by this increase in loan maturities. However, this report seems to imply that there is going to be a more measurable material effect from these maturities, maybe more so than we had anticipated. So I'm trying to figure out the numbers here. It says the quote is, although for most of the year the rate had easily topped 90%, this is the payoffs rate for multifamily properties. In September, it fell to 71.7. October brought it further down to 48.8%. Not only did more than half the loans in October fail to pay off, the October maturity defaults of $303 million make up over half of the $600.3 million of loans that have failed to pay off all year. So half of the loans that have failed to pay off come from this October. Do you know? I don't know if you know, but we did a research report that illustrated this very thing, and we did some updates throughout the year. We've been following this topic of loan maturities, and October's when it was supposed to hit. We said, look at October and November, and lo and behold, it's here. And it looks like it looks like there's $300 million worth of evidence that some people are hurting, and it's having a more dramatic effect. Because I thought that 99% of these borrowers would be able to talk to the banks and say, just listen, just give me a couple more months, I'll figure things out. But to have this, but to see it so dramatically in the month that they were due, is surprising to me. I felt like, and I do not know all the ins and outs and all the rules that, and how strict things are and how things work in this way. But I felt like if I was a borrower and I was doing okay, that I could go to the bank and bank, I get it. I'd rather you be able to pay me, period, than not pay me at all. So I'm going to give you an extension.
I mean, I'm sure that is the case, but they can't do that for everybody.
Yeah. And that may illustrate the size of the problem. Maybe that 99% or however, maybe the vast majority are getting extensions, but the problem's so big that it has cut that payoffs are about half as what they should be. Really interesting. And it is also interesting to think about how these maturities are going to be resolved in terms of like how are they going to get the money to get the loans? Are they looking for more capital? Are they going to put them for sale? And I think we're in this phase, I've mentioned it before, of figuring out what to do with this debt, of a non-bank lending, of working it out with the banks, of figuring out how to get, I don't want to say like short-term capital, but definitely like Band-Aid money solutions, so that people can survive till 2025.
Well, I mean, there's a lot of stuff that's going to happen. You're going to see some defaults, and I would imagine you're going to have some lenders that probably put the clamps on them and just say there's only so much we can do on a workout, or we have so many people in the portfolio at the same position that no, we're not going to give you a workout. So those are two situations there. The other being that you're right. I think there are going to be, there are going to be people that need to do rescue capital, not necessarily in the sense that they're in distress, but their plan was they had a bridge loan or some short-term debt that they were going to have to do a refinance on. And there's going to be a gap of where they needed to get a refinance amount versus where things are actually coming out. Mm-hmm. If it's a small enough gap, they're going to go the pref equity route. They're going to do or if they feel like
pref equity is in the non-bank lending, is that kind of in that larger category of non-bank lending, or is it adjacent?
I would say a little bit of both.
Yeah,
it really depends on where your source is coming from.
Yeah,
but They're going to do that, or if they feel comfortable, which I don't I don't know of how many people feel comfortable doing a capital call. If they can do a capital call there and get the money, they should be fine. What I think is similar to what I was saying the last time I was on, the two things that are going to be interesting to look at are people that, when they're in a situation of distress and in the event that they default and they have to go sell, how many of those deals are coming to market where it moves the needle enough that a lot of groups across the board that are in the space that we're in can transact? Because if it's a small enough portion where it's larger groups that have a lot of capital sitting on the sideline that they need to get out the door, it's not going to do enough on pricing to really change the market, because there's a lot of people that are banking on that these maturities are going to hit. It's a lot of people are going to be forced to sell, and
all
eventually
at once,
that heightens up the cap rate to meet where a lot of people are at in terms of struggling to get debt to purchase properties. The other scenario that's going to be interesting is the people that need gap equity, that they're finding themselves short on a refinance, or there's some sort of situation there within their equity. Is the amount of equity that they can get or raise, is it enough to cover what they need, or is it a situation of we need to raise an additional 10 million to save the deal? And because we've seen on deals that we've taken a look at from a pref equity standpoint, what we can give them and still hit returns on our end is not enough to give to cover what they need. So how many of those deals are out there? Is that the majority of people that are needing pref equity? Is it not? That's going to be another thing that's interesting to see. But another thing that I don't think is getting enough intrigue is what this does to equity sources moving forward. Because when you bring in pref equity, you're hurting the returns, and you're pushing the people that are common equity further down the stack. Depending on how big you are and where your common equity sources are coming from, what does that mean? Does that mean, do some of them pull out of real estate altogether? Do they stop investing in you as a sponsor? It's going to be...
We were talking about this in so many words, like yesterday and earlier this week, is like, there are some investors that are going to be, I hate to mince words here, but screwed. And they may not know they're screwed until 2 years from now, or they may just be in a bad investment. And are these sponsors and operators that are gonna be that are running this bad investment? Are they just gonna go back out and get new investors? Like, can they just? I wonder if the investor pool is big enough where they don't care. It's like, well, yeah, this deal didn't work, but we've got plenty more where that came from.
And so I was having that conversation with Jay yesterday, where I think it's going to be dependent on how many people, and it also ties into the inflation conversation that you and I were having, where how many people are just, stuff's more expensive, I'm pissed off, versus, okay, let's look at why things are expensive. There's government spending that was done in 2021. There was a supply chain issue. There was the war in Ukraine. There's stuff with the utilities have gone up. There's also, whether people want to admit it or not, a fair amount of corporate greed that went on to push it up. How many people are looking at those causes and realizing, okay, well, in some ways, there's not a lot that can be done immediately. How many people take I don't want to say a similar approach, but how many investors that are in these deals look at it and say, okay, I've invested with this group 10 times. 8, 7, 8, 9 times the deal's gone well. This has worked. The one time it didn't, and that's because significant inflation rose expenses. We didn't see that coming. Or as the conversation you and I had Friday, yes, we did floating rate debt. We did do a stress test, but we thought if interest rates got to 5, or we knew that if interest rates got to 5.5, we'd be in a tough spot. But we didn't think interest rates were ever going to get to, we thought they were going to get to 5.5. We thought they were going to get there 3-4 years down the line.
Especially not when rent growth's so low.
Right. And so what does that do to investors' mindsets,
Yeah.
I guess, moving forward. Are there enough investors that can say at the end of the day, this is an investment? You could lose money or not get the returns we thought, but 9 times out of 10, this has worked.
Yeah. I wonder, they always say that people are more apt to leave a bad review than a good review of a restaurant or whatever. I wonder how much of, what is 9 out of 10 good enough for investors? Could be, should be, probably. But there may be a lot of people that this is their only investment and they lose a lot of money. Based on some straight up false promises. There's several dramatic examples that we heard about earlier this fall of people that were looking for fantastic returns, and the only person that was able to tell them that they had fantastic returns was someone that may have been stretching the truth, and someone that has subsequently a company that crashed and burned since then. I'm not saying that that's happening across the market, but I am wondering what the push pull, like you said, what the push pull is from the customers of these. Essentially, the customers of these investment companies are investors, and can they afford to make them all mad? And what is going to make them mad?